This is Robert Keens of GoldSilverPros.com, and today I'm interviewing Nick Barisheff, President and CEO of BMG Group in Canada, regarding the recent situation of Scotiabank and them withdrawing from the precious metals markets and from the LBMA. Stay tuned for the interview. I think you messaged me recently about Scotiabank and them closing their metals trading desk. I believe there's also some additional news as to where they're withdrawing from the LBMA. Can you explain what the situation is there with Scotiabank?
Well, first of all, it was a surprise to us as well as all of the staff. So this wasn't something that was in any kind of long-term planning. Okay. And the underlying reasons are not really known, except that Scotia has set aside $200 million in cost of closing the precious metals division down. There isn't a specific date, but plus or minus some September, but for sure by year end. That's the timing. So the controversy comes up is that there's a lot of rumors always floated around that of the bullion banks being short and so on and so forth. So first of all, that may or may not be the case for everyone else. Like when originally I set these things up, and just by way of background, I was the manager of the investment division at A. LePage, and we had duly licensed in both securities and real estate. And I've sat through dozens of prospectus writing meetings with lawyers. So I have a good background in legal. I always say that I've had a $5 million legal education because that's the amount of money that's being spent on lawyers that I participate. So having said that, when I set out to set up DMG, I wanted to create something that didn't compromise bullion in any way, and always insisted, because I'm used to real estate title issues and so on and so forth, that there be clear title to the bullion and it's stored on a fully allocated basis and so on. So we spent about $150,000 with lawyers to make sure all that was right before we even started the fund. So in our case, the bullion for the funds and for our bars program is always being fully allocated. We get a monthly report identifying each bar by refiner, serial number, exact weight, and purity, and that's signed off by an officer of Scotia every month. And then twice a year we have the auditors confirm those reports. And then we've been to the vault many times because if we have a family office or a large advisor, we've been able to arrange a vault tour for them. So bottom line is, in our case, we've always had, as far as I'm concerned, fully allocated bullion with clear title to it. Now, the thing where all the rumors come in is that what people don't realize is that, for instance, when we sell bullion back to Scotia, so they wire funds to the funds to buy the bullion, but Scotia is not going to be net long at the end of the day. So what they then do is hedge it on the COMEX. So you have the physical markets and you have the COMEX market, and the two work hand in hand. Unfortunately, the physical markets, there's no real public disclosure. When Scotia buys bullion from us, that doesn't show up. So that's a positive purchase. But what shows up is the short position on the COMEX. This is where all the controversy comes in. Scotia's, in terms of dealing with all the Scotia people that we deal with, I can't imagine that there's always exceptions to the rule, but I can't see them stepping out of line to do anything illegally, because there's nothing in it for them. So if you're an employee of Scotia, there's nothing in it for you to to do anything illegal, that where you can end up in jail, and so on. So I'm not aware that that's happened, but I certainly believe there's manipulation in the gold and silver markets at the very least. But I've never had any specific indication from Scotia. Now Scotia got its claim to fame because they did a lot of Canadian mining deals. So when a mining company gets to the point of needing to buy equipment to get the mine started, Scotia was able to arrange leased gold from a central bank and lease it to the mining company. Mining company would sell it, pay for their equipment, and then repay the loan out of production. And in return, Scotia would get exclusive to the sale of their production bullion. So in a way, that's like doing covered calls, and that's a legitimate way to use leasing. I'm pretty sure that some of the other bullion banks, like the big ones, were doing sales of leasing of bullion to hedge funds that don't have any bullion to repay it with. So that's like selling naked calls. So that's where the difference comes in. Now, surprisingly, Scotia was the biggest of the banks. They did 4 times the volume in bullion as all the other Canadian banks combined. So they weren't a small player. But to Scotia's top executives, the precious metals business was like a drop in the ocean. And I think that if there was any liability coming out of it, then they just said, okay, forget this, close it up. That's my view, but the specifics for why they did it, they haven't really published that.
Do you think they were taking any sort of losses from their trading, or it was just more of a case of it wasn't worth it for them to continue to be in that business due to the size of it? And
well, it's hard to say. There's a lot of controversy going on that the COMEX has a lot of demand for delivery of physical bullion that they can't make.
Mm-hmm.
So somebody's on the wrong side of the COMEX trades, and it looks like it's becoming a serious problem.
Yeah, I have seen that news recently as well. There have been, I think, a record amount of JP Morgan in the silver part of COMEX, for instance, moved, I think, 30 million ounces from eligible to registered to be available for delivery in upcoming contracts. So certainly it looks like a lot of physical metal is moving into delivery to satisfy delivery contracts on the COMEX for sure.
Okay.
In terms of Scotia,
there's many mechanisms that the manipulation takes place. A lot of it is totally legal, maybe unethical. For instance, if you take the bullion ETFs, people are under the impression that they've actually owned bullion, but they don't. The authorized participants contribute leased bullion to the ETF. The ETF issues new shares. They get their shares, they sell it to the public, and keep all the money. Everybody thinks it's about management fees.
Mm-hmm. And it's not, because they don't own the gold.
No, and when you look through the material, you have to, in the case of this, you have to read the prospectus very carefully and the authorized participant agreements. And surprisingly, the authorized participant agreements are no longer on Edgar. They only appeared in the first year. So now you can't find the authorized participant agreement. But that's the key thing, and just practically speaking, you're not going to have someone like J.P. Morgan go to the market, buy bullion, contribute to the GLD at net asset value, get shares at net asset value, and sell those shares to the public at net asset value. There's no money in that.
What do you think changes are going to be in the market given, will there be any drop in the pond effect from Scotiabank withdrawing? Do you think it's going to affect any of the other players in the market, or do you think it'll affect either the physical or the futures markets?
Well, it's going to get more and more difficult to acquire significant amounts of gold, and the premise there is that, you know, if you look at the global pension funds, and other than I think 3 or 4 pension funds, they have no gold. But if the pension funds decided that they were going to even allocate 5% to buy gold, that alone would drive the price past 10,000 an ounce, because there isn't enough gold for the pension funds to acquire 5%.
So where is the safest place to buy gold right now? I guess, I mean, the retail market, it's very hard to find any ounces in any sizable quantities. So I've been trying to buy it for the last couple of months, and I can find it at certain places, but it's become fairly difficult. If you're buying something in size, if you're wanting, you know, $100,000 or more, how do you go about acquiring that? Do you guys have that available, or what is the best way to do it?
Well, we haven't had any delays in either our bullion bars program or our funds. But so far, dealing, you know, with Scotia is has it always been so far. And we've been interviewing alternatives, both to supply the bullion and as well as storing it on an allocated basis. So by the time Scotia gets out of the business, we expect to have those alternatives in place.
Yeah. And is there going to be a transfer from the gold? Is Scotia holding the gold? I know they provide it, but do they store it for you, or is it stored?
Yeah, we'll have to, you know, transfer it from Brinks, because we have just under 300 million of gold, silver, and platinum. So that'll have to be moved by Brinks.
Yeah, and just to note, Brinks is a very reputable storage facility. I think it's used by most of the major companies that provide storage services. They have a really, really good reputation in the market.
And we're talking to Brinks as far as possible storage, but in terms of Brinks, they don't qualify as a custodian for the mutual funds.
I see.
The mutual fund custodians need to be Schedule A banks.
Okay.
So that adds to the complexity.
Sure.
And there's only 2 other Canadian banks that are LBMA members, which is RBC and Bank of Montreal. And we need to have LBMA members so that the chain of integrity of the gold is maintained.
And is the Royal Bank of Canada, they're an LBMA member, aren't they?
Yeah, the Royal Bank and Bank of Montreal.
Okay.
And, you know, Brinks, of course, is an LBMA member, and the Mint is an LBMA member.
Well, it's certainly interesting news. I guess unexpected. I know there's a lot of conversation going around in the precious metals sector regarding what's going on.
Yeah, but there's been no definitive answer or reasons other than they've announced that they've set aside $200 million for potential losses.
Yeah.
So,
I know you may not want to speculate on this, but what could those losses typically entail? Does it have to do with them having to get out of certain positions, or does it have to do with just legal fees and things?
well, I think it could be like the issue of typically when you hedge on the COMEX, the futures contracts are settled for cash. But if people decide they want the bullion, then a lot of the people that sold the contracts may not have the bullion. It's kind of ridiculous to allow people like the bullion banks to sell an unlimited amount of futures without having any physical backing.
Mm-hmm. It is, because that creates
the COMEX rules.
Yeah, that creates virtual supply where there isn't really supply, and we know how that affects the price.
Right.
Okay.
So now if the bank was expecting to settle in cash and the other counterparties asked for delivery of physical, that creates a problem because then they have to go to the market and buy it, and that's where the losses could occur.
Okay, well, this has been interesting. It's interesting development for sure.
It's always interesting. It's amazing. Like I'm a firm believer that the gold markets have been manipulated in a multiplicity of ways, from leasing to COMEX to the ETFs. But as far as I see, you can manipulate the markets legally. You don't have to do anything illegal.
Yeah, that was I think that's been a big topic of conversation also. A friend of mine, Chris Marcus from Arcadia Economics, interviewed Bart Chilton after he was with the CFTC. And it was interesting to see some of the rules they didn't have in place to deal with some of the what's considered unethical trades on the futures market, and they did get a rule in place regarding spoofing, I believe, much after the fact, and some of the spoofing that went on there. But I think myself, studying how those markets work, I think there's a lot more that could be done in terms of making the market a little bit more fair and more transparent.
Yeah.
Not the least of which...
Well, at some point in time, something's going to blow up with the manipulated markets, and then you'll see an instant rise in the ballistic, and I think they'll lose control because manipulated markets, eventually they lose control.
Yeah, a lot of us think that could happen in the near future, and I think going back to trading on the futures markets, there needs to be a lot more transparency. For example, if you're looking at who has what positions, because if you're an analyst just reading through the COMEX reports, it's very difficult to tell what's actually going on. Everything's aggregated up to just a top line balance sheet number, and you can't really follow the market. And unless you're one of the big banks on the market and you're seeing all this data come across your platform, it's very difficult to understand. So it's not a market which is easy to participate for a lot of people.
Yeah, no, it's for the unsophisticated, the futures market is a guaranteed way to lose money.
I agree. Physical, so coming back to physical bullion, it's definitely the better way to go for, I think, the average investor, and even people that have a fairly large estate that want to invest. I never recommend playing around with either the futures or some of the funds because there's so much counterparty risk there and so much unknown as well.
Okay. I'm just writing an article because I think that's one of the things people always talk about. Well, you should invest 10% of your portfolio in bullion. Yeah. In my article, I'm turning it upside down because in U.S. dollars, gold bullion has increased by 10% a year on average since 2000, and something like 16% last year and 16% year to date. So the issue that when you deal with bullion, in my view, is that if you understand that gold bullion is actual money and everything else is currency that's just a debt instrument, and you start off at 100% in gold in the vault, and you don't invest it at all in anything unless you get more ounces back than you put in. And most investments since 2000 will not give you more ounces back. They'll give you less ounces back. So what's the point? Leave the gold in the vault.
Right. Not only is gold a safe haven, but basically you're being paid to hold gold.
That's right. And you don't need to screw around and risk your hard-earned capital and other bullshit investments,
Yeah.
And that's the point. Just leave the gold in the vault. Eventually, like when we have the market correction, then at that point in time, it's going to be worth taking the gold out of the vault and buy stocks and bonds and REITs at rock bottom prices. But that time is not right now.
No, but looking at the economics, we could be headed into that given what COVID has done to the economies, or I shouldn't say what COVID has done, I should say what the states have done and the governments have done because of their fear of COVID. It looks like we may have pricked that bubble. Lots of information coming out now about commercial real estate coming under fire and spikes in delinquencies across real estate in the U.S. Predictions on CNBC.
In commercial real estate, one of the things to worry about is that most commercial real estate leases have a force majeure clause, which typically is, riots, insurrections, things like that. And, nobody ever thought of applying the fact it's a force majeure when the government has ordered you not to come to the office, or you can't open your retail store.
Yeah, an article in CNBC was predicting 25,000 retail closures this year, which would almost triple what we saw last year, and last year was a very high number. So,
but then what happens is you have the landowners of the real estate not being able to make their mortgage payments, and then those mortgage payments go into default, and they won't be able to find new replacement tenants for years and years.
Yeah, I agree. I think it's going to be tough times ahead in the economy, and I think precious metals are definitely a way to go. I just did an article this morning on the precious metals miners, how all of the precious metals mining indexes are up now since March. In fact, they've all basically doubled or gotten better. So if whether you're in the metals, which I prefer, or even in the miners, you're doing pretty well right now, and I think that's probably the safest spaces to be.
Yeah, but the thing with miners is when we have a broad equity market decline, the miners tend to decline more than the equity market, even if the price of gold is rising. And that's because all the miners, the market cap of all the miners in the world is less than Microsoft alone. So that when you have a broad-based sell-off, they get caught in the downdraft. So what happens with the miners is they'll lose more money than the broad equity markets, but will become a hell of a buying opportunity at the bottom.
Yeah, that's something really good to consider. So I agree with you. I think cash and precious metals is probably the way to go. Thank you so much for the update on Scotiabank and what was going on in that market, Nick. We do appreciate that. And
okay, you're welcome.
You're going to be joining us here at the North American Monetary Metal Summit that we're going to be hosting here on August 6th. So we look forward to talking to you then.
Okay, great.
All right. Thank you, Nick.
Okay, take care, Robert.
All right.
Bye now.
Bye-bye.